Good morning, good afternoon, good evening, wherever you are. I'm your host, FD for SageFab.tv, and in this video, I want to share with you my own personal plan for the peak as well as the upcoming bear market. That's what I want to share with you. If that interests you, please keep watching. But housekeeping first, guys, this is not financial advice. Please do your own research. If you are not qualified to do your own research or you are not capable, please seek someone who's actually trained to give you financial advice. Here, I'm talking of professionals who went to school for these things. I'm just some dude on the internet, interested in everything crypto without any basis or underpinning knowledge of what I'm talking about. Okay, I just do research like everyone else. And this content is also not targeting UK audiences for obvious reasons. That said, if you are not subscribed, guys, please help us grow our channel. We rely on you just subscribing and watching our videos, liking the video. All these things are free, apart from your time, of course. That said, let's come back to why we might be entering the late stages of the current bull cycle. But before we jump into the tactics, let's ground the thesis here, guys. Here are some data-backed and logical signals suggesting we may be approaching a bull peak. My supporting signals for late stage where we are and where we are heading to include on-chain metrics signaling overheating. For example, crypto can't flag the bull market, which appears to be in its final stages. Others point to elevated market participation, rising MVRV, Z-score, and profit taking. Liquidity and inflows nearing extremes with record ETF inflows, for example, in recent times during this year, showing institutional capital flooding in, possibly saturating the demand side because any dip is being bought up straight away, and ETFs now and then they are recording massive inflows. And historical cycle timing as well, plus macro edge conditions, the prior bull cycles and durations of approximately 1,000 to 1,100 days. You're talking of 2.9 to 3 years from bottom to top. We may be approaching similar durations. I think we actually passed that now, depending on where you measure from, of course. Sentiment diversions and media saturation. When retail and mainstream media become obsessed with which coin will 100x next, it often signals the top is near. This is more qualitative but reliable in many past cycles. I don't think we've got that much retail yet, even though separate coins are popping up now and then with 100x's and stuff, but not the mainstream ones, probably the newly created. And risk from macro shifts, central banks may tighten rates, inflation may flare, regulatory shocks may occur. Historically, bull cycles often end when macro liquidity conditions reverse, but right now I think we are about to see looser liquidity conditions instead of tightening. But it depends. If inflation flares up again, we may see the reverse. Some argue that the cycle is not over yet. On-chain data suggests Bitcoin hasn't entered the euphoric tail. Is it a given? I don't know. But some analysts believe the bull run could stretch further to, say, 200k. If you follow this channel, you know we did another recent video where we actually said if the bull cycle spills into late, say, third to fourth quarter of 26, Bitcoin could easily smash 2 to 300k, I think, if it stretches that far. But that could be after a lot of people have left the markets. That's when things will go crazy. The likes of Arthur Hayes is also argued the traditional 4-year cycle may no longer be reliable, and that liquidity dynamics may allow the run to continue. So yes, the bull market may have more gas left here, but proceed as if it's nearing exhaustion, because you never get sent a notice or text message to say this is the end. It doesn't work like that. You realize that several months afterwards. So how do you maximize gains as the bull market peak approaches? Well, when you suspect you are near the top, the name of the game is capture upside while protecting capital. Here are some concrete steps I'm going to be taking as we approach that peak. I'm trying to scale out and take profits as we go, not in these markets, of course, when everything is red. I will not wait for the perfect top as certain targets are reached. For example, 2 to 3x multiples. I'll sell some of my holdings depending on where things are. So I've got certain things that are, even in these conditions, they're still like 900% up or 9 or 10x up and stuff. Those are things that are, if they double from where they are, I'll start taking profits from a private portfolio. In our public portfolio, things may be different. We'll play that separately, but in my private portfolio, we're in that situation now. I'll probably use tiered exit plans, such as I'll lock 20% at 2x, 30% at 3x, another 20% at a new all-time high region. In the past, it has served me well, so I don't suppose that will change now. I'll also try and use hedging and option where possible. This is not an area I'm an expert in, but I'm still learning. The use of futures or perpetual short position to hedge against a sudden downturn, or the use of put options if available to ensure a portion of my large holdings are secured. Some people will say try invest ETFs and short funds or synthetic derivatives as hedges. I know it's an option available to me, but I don't know if I'll actually utilize that. I'm just putting it all out there for some people who might be interested in that. But the goal here is to carry upside, but some cushion things for. I'll also be looking to shift capital into stronger or defensive cryptos. So as altcoins often often lead declines, I'll move portions of my exposure into, say, Bitcoin and stablecoins, top tier layer ones or stable collateral pairs, for example. I'll increase my allocations to projects with solid fundamentals, real usage, strong teams, and so forth. I also try and keep some dry powder in stablecoins and fiat, reserve some cash stablecoins so I can buy dips after the collapse. In the past, I've been, like many investors, missing the top and lose because I have zero ammunition when the bear hits. Things have changed now. I'm a bit wiser than I was when I first joined this space. I'll also try and use on-chain alerts and signals. I'll try and watch the MVRV Z-score, the whale multiple, NUPL, Bitcoin dominance, liquidations, open interest. If 3 or 4 of these flash extremes, I'll probably consider de-risking or accelerating de-risking because I'm already de-risking, so I'll probably accelerate that. And I'll be monitoring funding rates. Wildly positive funding often precedes price exhaustion and reversal. I'll try and not play with leverage at all, but if you are involved in leverage, you probably want to limit that if we are approaching peak, but I will try and avoid it completely because near peaks, reducing or eliminating leverage positions is always wise. The margin call risk rises sharply in volatile reversal, and I also rebalance often. As certain assets outperform heavily, I'll rebalance to reduce concentration and lock in gains across my portfolio. This is what I'll be doing, guys. And to prepare for the bear market and taking advantage of lower prices, well, once the bull run tops, you should actually be sharpening your weapons to shift from how high can I go to how far will it drop. So you're now looking, instead of waiting to see what is the highest price, you're thinking when is the floor. That again can be misleading. Defensive and optimistic moves in a bear market include switching to survival mode allocations, where I will be increasing cash and stablecoin exposure, move to assets with stronger fundamentals, deeper liquidity, and low volatility. Deeper liquidity is quite important because if you invest into an asset without any deep liquidity, the team or anybody could sell a small amount and that will collapse the price. So just be aware of that, guys. We've all suffered that because we think if something performed well this cycle, it's going to come back stronger next cycle. That's not always the case. I'll try and deploy hedges and short strategies using things like derivatives to short major assets or pairs, especially if things are going down already. Shorting the market is not a bad idea, I think, because it's going to get to basement prices. Things are going to collapse further because you're hitting the bear market. But the trick is knowing when you actually start doing that, because you might be done by a week. It's possible. It's been done in the past. Moving assets with stronger fundamentals, deeper liquidity, and lower volatility. Consider defensive cryptos or ones with built-in yield or utility, such as staking and income. And to be doing that, dollar cost averaging into strong assets with any reversed capital that I will have, slowly buying into top projects during sustained weaknesses or capitulation. In one of our previous videos, actually, when we were talking of price predictions, we covered some of the assets that were invested in, some not, and I was actually saying or stating some of the bottom prices I'll be expecting. So I'll try and pull that, dust that down and implement it through dollar cost averaging. This spreads out risk and captures bottoms. I'll be using liquidity mining and yield opportunities, but I've got to be careful here because in bear markets, yields often spike. I'll be using trusted protocols to stake or provide liquidity, but only with capital I can afford to lose, because you might do that and that protocol might collapse or a rug pull happens and you lose everything. So be careful. I'll be doing that and exercise extra caution, and I'll be avoiding crazy yield farms with unsustainable emission models, 1000% API and stuff like that. Where is the value coming from? That's a question you should be asking, because if it's too good to be true, it probably is. And I'll be capitalizing on project collapses and distressed assets. Many tokens and projects will die or deeply undervalued. But if I have deep diligence, I can cherry pick survivors at a discount. It happened during the last bear cycle. Not everything was a win, because some of them actually collapsed, but the ones that came through, they actually delivered. Even now, you're talking of things that are still 1000% or more up and are still even taking profits. So it happens. So I'll be using token rescue rounds, airdrops, on-chain arbitrage. Some airdrops are not bad, because I got the Arbitrum airdrop, I got the Wemo airdrop, I got quite a few airdrops. Some of them just by trading meme coins. I think one of them was Bonk. Others on Arbitrum, I think I was actively farming the airdrop, but it came as a surprise as well. So I did get a few. I could have got more, but some of these they were just up for that, or you could participate and they will just discount you at the end, or you're in the wrong region, you know, there's something. Okay, I'm not gonna waste my time. It's an airdrop after all. It's free. Next, I'll be considering things like portfolio Pareto trimming. selling or cleaning dead weight during bear markets. Many speculative altcoins will crash hardest. I'll be evaluating frequently, cutting assets that repeatedly underperform or fail. The ones that have actually failed during this bear market, I'll just cut them. If there's still something left, I'll just sell out. Even during these peaks, even in deep losses, I'll still sell them because they haven't delivered. They've failed. I'll also be looking at tax harvesting as well, where I can take losses and then set them against future profits or any profits I make. Should be the case. So within my jurisdiction, which is the UK, it's allowed to do that tax harvesting. I think it actually goes, is it 3 or 4 years or something like that? Probably 5. It used to be 5. I don't know how long it is now, maybe 2 or 3. So here are some examples of what I'll be doing. The phase, if I start with the phase, late bull, 2x to 5x region, I'll be applying what I consider, for me or anywhere, I'll consider it to be tiered profit taking, partial hedges, move toward top cryptos, and the goal here is to lock gains while maintaining exposure. Because if you move out completely and the bull market goes bonkers, you're gonna miss out on probably the highest gains you could have had. So exposure, remaining exposed is always a good idea. If it's a suspected top as a phase, I'll probably go for heavy exits, reduce leverage. If I am, and I don't get involved in leverage that much, I'll increase my cash and fiat and stables and the hedge protection. And the goal here is to protect capital from the downside. And if the phase is the decline phase, I'll DCA into best projects, deploy hedges, and rotate to defensive. And the goal here is to build positions at favorable prices. And if it's a deep bear market, simple. I'll be actively rebalancing my portfolio, cleaning up my portfolio, and looking at opportunistic buys. And I'll be preparing for the next bull cycle to begin. How long the bear market will be, that's debatable. But the bear market, that's where you make money. In a bull market, you're only realizing the profits. And some practical tools include using limit orders or stop limiting orders rather than market orders in volatile reversal phases. I'll be using trading boards or scripts that trigger exits or hedges when indicators, for example, funding is greater than threshold and MVRV is greater than threshold hit. And I'll also be using alerts in block explorers or on-chain metrics dashboards, for example, on Glassnode and CryptoQuant. These things you need to subscribe as well, and some of them actually pay for the service. So be aware of that, guys. And don't forget to keep stablecoin and fiat wallets ready at all times for quick deployment. Was in a bear market, I made some of my best moves in bear markets, where in bear markets you get market makers going crazy. They will just pump some coin 800% within 24, 48 hours and make a killing during that period. And there are some risks and counter arguments, so you should not be blind to bias here. The bull run might continue longer than expected. Some believe liquidity and macro conditions still support extension, and hedging cost and slippage in extreme moves can erode profits. And don't forget poor timing. If you de-risk too early, you might miss large upside. Derivative counterpart risk as well is in play here. Liquidation risk if hedged improperly. Regulatory or technical shocks, for example, chain splits, protocol failures, could append even safest plans. Hence the importance of multiple signals, gradual adjustments, and diversification of strategy. What strategy are you employing, guys? Let us know in the comment section. My final thoughts on my plan for the peak as well as going into the bear market. I'll say this. Think of a bull market like a high tide lifting all boats, but the highest sails are most exposed to wind. As we near the crest, it's not just about riding higher, it's about which boats survive the storm. The smart play is to milk the large sage, hedge your downside, hold bullets of stable capital, and pick your spots when the tide recedes. Markets don't whisper the top, they scream risk in microcracks, overextend sentiment, extreme funding rates, greed flows, reckless leverage. If you hit those whispers, you will maximize your moonshots and survive the crash. In real life, lock profits, hedge, rebalance, accumulate on dips, and keep powder dry. Because when the next bear opens its jaws, the real winners will be those who didn't drown. Where are you? Where are you going to sit? Let us know in the comment section, guys. Until the next one, FD for 6.0 TV. Signing out for now. Bye.